Hey guys, in this lesson, we're going to learn about prepaid expenses. Prepaid expenses is the value of the cash payment made in advance for expenses before they are incurred. Said differently, prepaid expenses represents the value of the products and services that have been paid out for, but not received or used yet by the company. A common example is insurance. Companies pay for insurance coverage up front, but they only reap the benefit from it as the policy period goes by. Another example could be rent. If a company pays the entirety of next year's rent, that's a prepaid expense. It paid for the entirety of next year's rent, but obviously next year hasn't happened yet. It's the same concept as receiving cash payments from customers up front before providing goods and services. Just that in this case, the company is the customer making the upfront payment. Prepaid expenses is usually a current asset. Naturally, some people might ask, why is prepaid expenses considered an asset? Because it represents the value of goods and services that other parties owe to the company. It's the value of goods and services that other parties are obligated to provide for the company in the future because the company has already paid for it. Now, if it was the other way around, if the company has received other parties' goods and services but hasn't paid for them yet, then the company would be the one that owes other companies. But prepaid expenses characterize situations where the company has paid for things already and other parties owe the obligation to deliver goods and services to the company. Remember, if someone else owes the company something of value, that's an asset. Coming up next, we'll learn about the most common long-term asset line item, known as property, plant, and equipment, or PP&E.